please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, that's a whole lot of ups and downs that we have to negotiate today on Bazaar. Welcome to Bazaar Morning Call. I'm Lata. With me is Sonia, Anuj, and a fourth host for you today, Reema Tendulkar, joining us all the way from the TCS headquarters. Good morning to you, Reema. I know you have a hard day's work ahead. Coming to you in just a minute, I'm just putting a bunch of cues over here. I think it's super IT and somber rest of the market as of today. Well, in the first place, the TCS guidance looks, as of now, positive. They expect BFS to turn shortly, and some of the parameters have been better than what the market was expecting. Mindtree was also good, but the most important cue going in favor of the IT stocks is going to be the rupee. In the NDF market, it is trading at 66. So while that may be a result of bad macros, it's that part of the market's got something positive going for it. But then there are the other somber cues. Crude remains at 4-year highs between 73 and 74 barrels, $74 per barrel. And as I told you, that's brought rupee to 66 in the NAF market. For me, the more important cue is also going to be the MPC minutes that clearly sounded hawkish. After the policy, we got the feeling that for the rest of calendar 2018, maybe even FY19, that's up until March, there may not be a rate hike. But now you just can't rest on that assumption. That could push up yields. And therefore, there is enough for the market. There is also a fairly aggressive statement coming in from the Power Minister, which actually will be immediately maybe positive for, debt-laden stocks like power stocks. But nevertheless, that's not a very positive thing, despite this kind of a clash between government and RBI. That's a mild negative overall for the economy. So as I see it, IT, yes, but rest of the market, I'm a little worried.
Well, hi, good morning, Lata. Good morning, Anuj. Morning, Reema. For the market, when we started off about an hour back, the SGX Nifty was a bit under pressure, but now most Asian markets have actually recovered from the lows. Some of them are even trading in the green. So let's see how that plays out, because we saw good buying from domestic institutional investors yesterday once again. As you can see, those markets have also recovered. Anuj, morning. So far this week has not been too bad, right? Yeah. We have been picking up pace. So this buy on dip strategy has worked. You get a sense that today could be the same, or would we face some resistance at higher levels? Yeah,
morning, Sonia. So today I think the market could be giving you that dip, though I don't know by the time you open. The SGX Nifty yesterday also we said that, the start at 10,600 looked unlikely. So let's see if the dip is good enough for 40-50 points. Just look at last 3 days, April 17th, 18th and 19th. And this point needs to be emphasized. We've opened on 17th at 10,557. What was the high? 10,560. 18, 10,579 is the open. High was 10,594. Yesterday opened at 10,564. High was 10,572. We closed at 10,565. Short point, if you buy on a gap up, you're not going to make any money. In fact, you're going to lose money. So if intraday dip comes or if a gap down comes, you got to buy, because this market is in a bit of an uptick right now. It's facing a bit of a resistance at 10,550 to 600, and that's because that's the 50% retracement zone of the overall correction. But if it was such a massive resistance, in that case, the market should have fallen at least 50-100 points. That hasn't happened. So obviously, it looks more a matter of when and not if this zone is taken out. 10,550 to 10,600 is taken out or not. Do we have graphics to show that point? Okay. There's also the point that the FIs are selling in cash market, but they are buying in futures. So obviously there's a bit of squaring off of long positions and some long build up. The net FI longs, they have doubled since the start of the series. At the start of the series, they were 19%. We're now at about 38% net long. And also the mid caps have done well over the last 3 or 4 days. Yesterday also a lot of stocks actually ended at high points. So over the last 3 or 4 days, we have seen quite a bit of buying over there. And while we all will discuss TCS threadbare through the day, I will make a technical point on TCS. And for some time now, it's been my call that IT is the leader, and within that TCS is really best in class. And these numbers really reiterate that. More than the numbers, you ask yourself, why does the Tata Group get this kind of corporate governance premium? For example, at Titan, the kind of valuation that it has seen. You had a block deal in TCS from Tata Sons about 1.5 months back. And after the block deal, actually the stock fell, and is now at all-time high. And today it's likely that it rises even more. There's going to be a bonus issue as well. There's a good chance that over the next 3 or 4 months, the TCS stock makes a move towards say 3,400, 3,500. It's entirely possible. But any other promoter could have held back, selling that stake. It's not pressing need. Right?
Yeah, he knew that he was giving a bonus.
Exactly. And so, it just tells you, it reiterates the importance of corporate governance. And that's where, Tata Group has really got that premium. And that's where TCS really, and TCS frankly is one of the best Indian companies. And I think that's why it has the highest market cap and has got the premium that it commands over all other companies.
Every word you say is worth its weight in gold. There's no two ways about it. But on that note, Rima, we've kept you waiting long enough. Tell us key takeaways that the street took from the TCS numbers.
Well, Lata, it was a trend-setting quarter from TCS this time. A beat coming on revenues after many quarters. Dollar revenue growth 3.9%, expectations 2.5%. Constant currency revenue growth 2%, expectations of 1 to 1.2%. The company's managed to improve margins by 20 basis points to 25.4%. But more importantly, it's the commentary for FY19, which is also optimistic, which makes the analyst community believe that perhaps even double-digit growth is likely for TCS in the coming year. So first, on the troubled BFS sector, they sounded a lot more optimistic, though they said we will want to wait at least till Q1 before, getting a clearer picture. But definitely optimistic on BFS, with the management saying that perhaps it's bottomed out and they're incrementally more positive. Even on retail, on account of the strong deal wins, they've ended the year with an 8.4% constant currency growth in retail, and retail was a beleaguered sector for the company at the start of the year. Their deal wins have been very strong. They've gained scale in digital. Digital is now a $4.7 billion portfolio for annualized for TCS. It's seen a growth of 42% on a year-on-year basis in Q4. They continue to maintain their margin guidance of 26 to 28% on the back of as growth picks up, they will get operating leverage. Secondly, as digital gains scale, they will be able to eke out some operational efficiencies. And thirdly, on account of rupee depreciation. So on all parameters, TCS seems to have ticked the boxes this time. And plus, they've announced a bonus in the ratio of 1:1. The stock has been an outperformer, 18% rally so far in 2018, very close to its record levels. It's quite likely the stock is going to move up today, and it's also trading at premium valuations at about 25 times premium to its closest peer, Infosys. So good numbers. It's gained its momentum and its mojo back, definitely.
Thanks a lot for that, Rima. Yes, actually, valuations have risen quite a bit. So if you look at the FY19 consensus EPS stands at about 150 rupees. That gives it valuations of almost 21 times FY19, something that we haven't seen in a long time for TCS. But let's take a look at what our wise experts have to say. We'll, of course, keep going back to Rima. She's going to interview the management as well. But let's get some views in. In his weekly blog, CLSA's Chris Wood says, and I quote, "Greed and fear observes in meetings with local institutional investors in India this week a healthy lack of exuberance. India has certainly not been the flavor of the month so far in 2018, with a bond market sell-off and concerns about a renewed rupee weakness on the back of rising oil prices and a rising current account deficit. There is also much talk of fiscal slippage amidst fears of a resurgence in populism ahead of the general elections due in 2019. The Indian story would, in Greed and Fear's view, be badly damaged if the formidable Narendra Modi was not re-elected. Still, in Greed and Fear's view, it is too early to pontificate about next year's poll."
Okay, so that's a slightly cautious view coming in from Chris Wood. Let's quickly put in money market views, because we're going to have a guest joining us shortly on that. Bhaskar Pound of HDFC Bank says global crude oil prices are marching higher on the back of demand and disciplined adherence to production cuts by OPEC and non-OPEC members. A surging trade deficit also is a matter of worry. As well, the US yields have also rallied yesterday. Given this background, he expects the USD-INR pair to continue to remain under pressure, and adds that 65.94, which is a technical level now, beckons. Bhaskar expects the rupee to trade in a range of 65.80 to 66 against the dollar today.
And on the bond market, Bhaskar Panda says the underlying tone of the RBI's MPC minutes released yesterday has turned hawkish as more members join the withdrawal of accommodation bandwagon. Given this and the higher US yields, he expects the yield of the 10-year benchmark to remain elevated in a range of 7.6 to 7.7% today.
Right. It does look like somebody got the MPC minutes earlier or got it right, because yesterday we already saw a big rush in yields, rise in yields. But let's parse the MPC statements a little more and check out how the bond markets might react. Manish Vadawan, Managing Director and Head of Global Fixed Income at HSBC, joins us on the phone line. Manish, good morning. Your thoughts, MPC minutes and impact on bond markets?
Good morning, Lata. The MPC minutes actually came as a bit of surprise to markets, because I think the tone of the policy and when you saw the details in MPC minutes, they were quite different. And the more you go into details, you realize that all the MPC members are pointing out to a few things which are common. One is there is a risk of higher inflation, and there are a lot of talks about that. Second thing is about the growth part. Third is about everybody's talking about that we are nearing a situation where the output gap could be getting closed. And everything put together is definitely gave a sense that they were contemplating, or they had thought in their minds, nearing a stage of withdrawal of accommodation. But I think the biggest surprise came from Mr. Viralacharya's comments, which actually said that he is now ready to change his stance towards from accommodative towards, I don't know, what would I say, tightening or
accommodation is his word.
Yeah, the accommodation getting removed, and I am ready to move that stance in June, which actually is something I would say a bit surprising for the markets if you compare it with the monetary policy on that day, the statement which got released.
What would all of this mean for the policy itself, Manish? What is the expectation from the June policy from your end?
See, definitely now the expectation turns far more hawkish. Whether they deliver it or not, I don't know. But coincidentally, because world markets started falling off and we saw oil going up, and along with that, what has been going on in the Indian markets, the apathy from a large section of the market which has not been participating. So it's a combination of all the factors. Definitely, market would start faring in a rate hike, or price in a rate hike, but whether it is June or August, we don't know. Underlying bond yields definitely would react again 10 basis points today. So we have seen a change of weather in April itself. Can you imagine a 715 and then 775 back? So it's huge volatility, what we are going to embrace for markets. As far as specific policy is concerned, I would say that definitely I think the tone would get a bit more hawkish in June, but I don't expect a rate hike in June. It could be set for future. That is what I said.
What are the yields likely to do today and say in the near term? Is it 770 today? Are we moving in a 765, 775 band?
So, Lata, you might definitely touch around that 775 level, because markets have this tendency to trade these specific, quarterly numbers, 7.5 and 775 and 7/4. So, 775 you definitely see today. Sustainability is only dependent on whether the new players are able to take these positions. Coincidentally, in the last 2 days, we've seen around 4,500 crores of selling from, $1 billion selling from the FPIs also. So they have also turned cautious. A combination of all these factors would definitely be weighing on the minds of the market.
Okay.
And with the low risk appetite, don't expect too much of recovery.
Okay, just one last word on the rupee. Is it 66 or does it get even worse?
I think it should open around where you're saying, because that is what the clues are. But, surprisingly, Lata, the factors which are dominating the rupee are quite different, and what you see is a lot of stability. Whether it is due to intervention or due to flows, we really don't have an answer. But even with high oil, even with the FPI outflows, things have been quite stable. But I personally feel if the way oil is moving up and we saw some kind of dollar strengthening across and dollar ratio moving right, you could see a band of, you could see rupee touching 66.50 also, maybe in a month or two.
All right,
Okay.
Manish, we have to leave it at that. Thank you very much for joining us.